From economic powerhouse to an economic depression called the lost decades. What happened to Japan? It's the 1980s, and Japan is an economic juggernaut. Skyscrapers are rising, the Nikkei stock index is soaring, and Tokyo land prices are worth more than entire countries. Sound familiar? It's a story of dizzying heights and crushing lows, not unlike some of the booms and busts we've seen in the US. Some are even asking if the US is due for a similar deflationary bust. In this video, we're diving into Japan's wild economic ride from 1980 to 2000, the asset bubble, what caused it, and what happened when it popped. We'll also compare it to the US, exploring what these two global giants have in common and where their paths diverged. So, over here on the left, we have the Nikkei. This is the Japanese stock index. Here on the right, we have the NASDAQ. This is a stock index of tech companies here in America. I will show the S&P 500, which people might be more familiar with. Similarly parabolic. Everything is getting so expensive, whether it's housing or the stock market, that there is a general sentiment, especially amongst normal people, that everything is so stretched that it must pop. The bubble must pop. The everything bubble must pop. We must have deflation, recession, depression. There are growing kind of sentiment of a coming depression, of a coming recession. Well, we can look at Japan, and I did do a video on the lost decades that'll focus more on that period of time. But for this video, I want to focus more on the asset bubble, what caused it, why it happened, what caused it to pop, and again, similarities between Japan and America. So again, we can see that clearly there was a stock market bubble here going into the early 90s in Japan. Again, you can draw whatever parallels you would like with S&P 500 or say the NASDAQ, and then it popped. In 1990, it popped, and the stock market sold off over 80% from 1990 to 2003. Now, the Nikkei has since recovered and is actually back to a new all-time high. Is not a new all-time high inflation adjusted, but is a new all-time high. And so it's important for the context that to note that Japan's economy from coming out of World War II to now is much different. Same thing as the US. Our economy coming out of World War II, we had actual industrial capacity. We could actually build things. In fact, we rebuilt Europe and most of the world that was so badly damaged by Japan by World War II. That includes Japan, who we clearly in World War II just utterly destroyed. And the economies were much different. So it's difficult to draw parallels from, say, the 70s or 80s to now, because both in Japan and in America, we were not running the sort of trade deficit, current account deficit that we were back then. Japan, likewise, was not as nearly as liberalized and kind of capitalistic as they are today. So, in the 70s and 80s, American businessmen went around the world and tried to liberalize the world. Whether it was Russia or Japan, we went around and tried to liberalize economies. And sure enough, we were able to get some of that liberalization in Japan, and some of it fueled and caused this asset bubble that we see here in at least the stock market. But it's important to note that before that, so going back to say the mid '60s, Japan was starting to emerge. Right, they were starting to recover from World War II and the utter devastation of World War II, and come out of it. And certainly by the '70s, Japan was really starting to take off. By the '80s, it was surging. In fact, people were calling it Japan Inc., Japan Incorporated. There were concerns among the West, even in the US, which, by the way, we were not running a current account deficit. We were actually, we had significant industrial capacity, industrial might. So it was even back then, with that industrial might, we were worried here in America that Japan would overtake America in terms of economic output. And it was not for no good reason. GDP per capita going into 1991, from 1962 until 1991, grew by 322%. Nominal GDP going into 1991 grew at 6,760%. Of course, personal savings was surging as well because they were running such a large current account surplus. Here is the Nikkei. So again, this is just a longer term time frame. look at the Nikkei. Then we're looking at GDP on a year-over-year growth rate basis. So in the 60s, certainly by the 70s, the electronics and automobile sectors in Japan were quite strong. Now, it's important to note I had mentioned that Japan was not nearly as capitalistic or liberalized. Japan's central government, the federal government, played a much heavier role in, say, industrial and trade policy. They had something called the Ministry of International Trade and Industry, and this, was they closely coordinated what we in America would say. You're coordinating monetary policy with free market industry. Well, to them, that's just how they approach the economy. And actually, it worked quite well. We had just looked at their GDP per capita, personal savings. The average Japanese person was actually doing quite well with that kind of mixed economy or much less capitalistic approach. Now, there are certain things Americans might look down their nose at. We might call certain practices, say, monopolistic, but that's just how it was in Japan. Now, of course, all that changed in the 80s with some of the liberalization efforts and of course deregulation that occurred not just in America but also in Japan as well, leading to a rise in speculative behavior, risky activity, risky lending. But back then, in the 70s and into the 80s, they were a much more mixed economy. The government took a much more active role coordinating monetary and fiscal policy with the industrial and trade policy side. This fueled, and then into the 80s, I mean, that fueled strength, that fueled growth, fueled, a couple, what some would call monopolies or oligopolies, but it fueled strength nonetheless. Then by the 80s, this was when American businessmen kind of went around the world and were trying to really push this deregulation and kind of liberalization of financial markets and economies. Sure enough, we were successful in Japan. And so this fueled a massive bubble. It was not only the growth, I mean, Japan was having very significant GDP growth, very significant real, GDP per capita growth. Their economy on a real basis, it was actually growing at a very strong rate. Of course, in a bubble, things get disconnected from reality. GDP on a year over year basis, just for perspective here, 1988 reached 9%. Here, in 1990, going into kind of the pop, it was 8%, 7.5%. As well as here in the mid 80s, where it was 7% as well. So it was working to some degree. If you were in the stock market or in the real estate market, here's the real estate market. This is lined up to the same date time period. So it's the same time period. I tried to line it up the best I could. If you were in the real estate market, if you were in the stock market, this was great for you. You loved the speculative behavior. The stock market, for example, increased here, let's just say from 1982 up until here, 440%. Real estate values similarly surged. And in fact, the real estate market of Japan was so crazy that they actually, the value of the central garden, the central government's garden, I guess the equivalent would be maybe the National Mall. It's a tiny little garden in the royal palace. That tiny little garden, I think it's like 1 square mile, was worth more than the entire real estate value of California combined. It was worth more than the entire real estate value of Canada combined. And so the bubble, it's really hard to kind of understate just how significant the bubble was. Now, part of this was due to the money supply. So I had mentioned liberalization efforts, I had mentioned deregulation. There was this huge push by American kind of Keynesian businessmen to go over there and encourage them to be much more laissez-faire, much more capitalistic, much more Keynesian. And sure enough, they adopted those suggestions. And one of the things that fueled the bubble was a massive growth in the money supply. So hopefully here in white, you can see the money supply percentage change from 1968 onward. You can see that it starts to curl up. So this is a regular chart, but it starts to curl up and start to go kind of parabolic. Now, the reason for this is twofold. One, there was massive deregulation, and two, there was an encouragement by the central bank and by the central government to lend money. In fact, if you were a young couple looking to go buy a house, say it was 1,000,000 yen and you wanted to buy a house, the bank would give you 1.5 million yen. Even though the house only cost 1,000,000 yen, they would give you 1.5 million. So they were really, really, really encouraging lending. Well, remember, private banks create money. Private banks, just like the government, just like the treasury or the mint, the private banks can print money as well. When a private bank extends a loan, a new loan, that is printing money. And we can see that reflected in the M2 money supply. It starts to curl up and go parabolic. And clearly, this was during the period of time where you had that kind of final leg higher in, say, the Nikkei, or we were looking here at the real estate market, where again, one tiny little garden was worth more than the entire real estate value of California combined. Well, clearly that all popped. Why did it pop? It popped in 1990, and so it's important to look at the Plaza Accord. If you're familiar with the Plaza Accord, you're probably thinking to yourself, it's the Plaza Accord, it's currencies. So let's look at that. So here's the dollar index. This is a basket of currencies that the dollar is compared to. So as the white line is going up, the dollar is strengthening in general. And then in red, we have the dollar yen. This is the specific exchange rate for just the dollar yen, just comparing the dollar to the yen. Remember, if the dollar is weakening relative to the yen, the red line will go down. If the dollar is strengthening relative to the yen, appreciating faster, the red line will go up. And so here in 1985 was the Plaza Accord. And what this was a monetary reordering of the major economies in the world. And the reason for this is that the dollar had strengthened so much going into 1985. It was just going vertical. Well, remember, this might sound like a good thing, but if you are trying to export goods, if you're trying to sell stuff to the rest of the world, a strong currency, especially an overvalued currency, is actually the opposite of what you want. And we started to run a kind of a trade deficit in 1982, a current account deficit in 1982, but there was at least some understanding by American policymakers that this appreciation in the dollar needed to be reversed. It was too much. Yes, we ran a trade deficit, current account deficit, but there was at least some recognition that that having a massively overvalued currency was bad for us. So we, had the Plaza Accords, which was a agreement by the major economies to weaken the dollar, to devalue the dollar relative to their currency. And sure enough, we can see that the dollar versus the yen similarly depreciated going into from 85 into the early 90s. Now, remember, for Japan, you could think of this the opposite way. If the dollar was weakening, that means the yen was strengthening from 85 through to the mid 90s. It looks like it set a bottom in 95. So for 10 years, from 1985 to 1995, the yen was strengthening. Now, for Japan, we mentioned that electronics industry, that automobile industry, they ran a massive current account surplus. So, the opposite of America, where we run a trade deficit, in Japan, they run a current account surplus, meaning they export more value than they import. This means that they accumulate national savings. Now, here is industrial production on a year over year basis. Again, you can see that from the 70s into the 80s and early 90s, industrial production growth was very, very high. It was above, 7, 8, 9, 10%. It was very, very strong. Well, we can see the current account surplus that Japan enjoyed. So here in 87, they were running a 4.3% current account surplus relative to their GDP. This is very, very high. Here we can see it's at a new all-time high going into '08, 4.7. But anything really above 3.5 or 4% is considered very strong. And clearly we can see, the effect that recessions have on other economies, not just the US. These red shaded areas are US recessions, but it clearly affects the rest of the world as well. But in general, Japan ran a current account surplus. So what this meant is that they accumulated savings. Again, what a current account surplus means is you are selling more stuff to the rest of the world than you are importing, then you are receiving more money for your goods that you're selling to the rest of the world than you are paying to the rest of the world for their stuff. So hopefully that makes sense. Well, you accumulate in general on a national level in the aggregate, you accumulate savings. Now, on the opposite end is the US, where we run a massive current account deficit. It's actually even worse than this. This data is lagged. It's closer to 5%. But the US runs a massive current account deficit. And so the only thing the US can, or any twin deficit nation can accumulate is debt. So while a current account surplus country can accumulate these national savings, and we see that reflected in the personal savings rate, for example, on the other hand, if you run a current account deficit or a trade deficit like the US, the only thing you can accumulate is debt. This is part of the reason the US is in the debt crisis and fiscal crisis that it is because we run such utterly insane trade deficits, current account deficits. Really, on a national level, the only thing we can accumulate is more debt. While on the other hand, Japan can accumulate national savings. They have what's called a net international investment position. This refers to the difference between what foreigners own of their assets versus what Japan owns of the rest of the world's financial assets. The difference between those two values is called the net international investment position. And then you compare it to the country's GDP. So for the US, our net international investment position, or NIP, NIIP, is negative 100% of GDP. I'm not familiar with any country in the history of the world that has ever had a NIP that low. Well, Japan's NIP, for example, is positive 80% of GDP. It's actually 85, closer to 85% of GDP. So running these current account surpluses over time has meant that Japan has accumulated huge amounts of not only savings, but those savings are put into assets, right? Like, for example, US Treasury bonds. This is why Japan became the largest buyer of US Treasury bonds, is because they were running such a strong current account surplus. Well, if your currency starts to appreciate as it was doing here, this is horrible news for your type of economy. If you run a trade surplus, a current account surplus, this is horrible, horrible news. Because what this means, a strengthening currency, remember, as the dollar is weakening, that put another way is the yen strengthening. This means that your stuff is more and more expensive for, say, the U.S. Now the yen was strengthening against other currencies as well. So all that stuff that had made Japan so successful, their current account surplus that had accumulated savings, national savings, right? They were receiving more money for the stuff they were selling than they were spending on stuff from the rest of the world. Current account surplus. Because of this, that strengthening in the yen was quite scary, because that was their entire economic model, was to run a current account surplus, to sell more stuff to the rest of the world than they purchased from the rest of the world, to accumulate that national savings, to run a current account surplus, to not be a debtor nation, to be a creditor nation. And sure enough, here we can see debt to GDP. So here in 1991, their debt to GDP was 65%. US was actually lower here in 1991. It was 60%, but they were growing roughly in line. Then, of course, the lost decades hit, and Japan debt to GDP just absolutely skyrocketed. This is one of the reasons why the lost decades were allowed to happen. Their leverage ratio, their debt, the amount of leverage in the system was low enough that they could stand some degree of deflation. Now, the US at 120% debt to GDP, and certainly Japan now at 230% debt to GDP, you get to a point where the central bank just basically has to print money to buy all the debt. And Japan took this to a radical level with yield curve control and negative interest rates and all that. But the point here is that, if you are a country that relies on selling stuff to the rest of the world, you cannot have a currency that is getting too overvalued, like they felt that it was here after the Plaza Accord. Now, it's important to point out the dollar right now, the DXY index, is at 97. Back here in 1985, at the peak, going into the Plaza Accord, on a purchasing power parity basis, the dollar was actually less overvalued then than it is now. Or put another way, the dollar today around 100 is more overvalued on a purchasing power parity basis than it was here in 1985 going into the Plaza Accord. So I think that's important context. Well, the strengthening yen again was worrying them because they relied on running a trade surplus, a current account surplus. So you don't want to have too strong of a currency because that makes your stuff less competitive for the rest of the world. So what did they do? In an effort to kind of offset the appreciation in the currency, here we can see the green line coming down here. In an effort to offset that, they cut the interest rate. So here's the real rate. So this is called this. You take the interest rate, and for this example, I'm using the central bank overnight interest rate that the central bank sets, and then you're subtracting out the inflation rate. And we can see that generally, going into the Plaza Accord, the real rate was above 3%, meaning global capital would make a positive 3% return over inflation if they bought the yen and then bought short-term bonds. Now, one way, if you're trying to weaken your currency to offset strengthening in your currency, one way you can do that is by cutting interest rates. Because what this means, and we can see at the bottom here, the real rate basically got down to 0%. What this means is that if I'm an American and I sell my dollars to buy yen and then buy short-term government bonds, I'm making 0% money. Over inflation, I'm making basically nothing. I'm making like 10 basis points. And so by cutting your interest rate down to zero or even below the inflation rate, that would be a negative real rate. What that can do is disincentivize the rest of the world from buying your currency and then buying bonds with the yen. And sure enough, it worked. And we can see that the yen started to appreciate, depreciate. The dollar started to appreciate following those cuts in the interest rate. So the dollar started to reappreciate, or put another way, the yen started to weaken. This is what they wanted. They wanted a weaker currency because, again, that means the rest of the world is incentivized to buy their stuff. That is what had made their economy so great, and in general makes economies great. That is why China's economy is so strong. They run a massive current account surplus. They are a creditor nation, as opposed to, say, the US, which we know is a debtor nation, as we can see from this chart. Well, by doing that, this was at the same time as an asset bubble. This was at the same time that M2, right, the private bank side was encouraging lending, right? They were giving even more money for mortgages than the house was worth, right? So private banks were lending more and more money. While on the other hand, you had the central bank cutting the real interest rate down to basically zero, which again is stimulatory, inflationary on kind of the financial plumbing side. For the financial plumbing on that side, well, that was being stimulated by a 0% real rate by the central bank at the same exact time that you had the private banks greatly increasing the amount of yen creation, private credit creation by the private banks. And so sure enough, this fueled both of them in combination, right? The central bank actions as an effort to try to counteract the strengthening of the yen, cutting the central bank interest rate. Well, likewise, private banks were also extending more and more credit, driving inflation, driving the asset bubble. And we can see that here reflected in the Nikkei. And of course, remember, here is the real estate market. It also fueled a bubble there as well. Well, the bubble started to get to a point that it started to concern and worry the central bankers. So in 1990, because the central bankers and policymakers were so concerned with the kind of absurdity of the asset prices, they started to raise rates. So they took the interest rate here. The actual central bank interest rate was not zero, it was 2.5%. But of course, the inflation was 2.5%. So you get a real rate of zero. But the actual central bank interest rate nominally was 2.5% at this time when you had 0% real rate. Well, the Bank of Japan, because they were so alarmed by the asset bubble, they hiked. and they hiked that central bank interest rate from 2.5% to 6%. And clearly, we can see that reflected in the real rate. They got back to that kind of 3% real rate, meaning, again, if someone in the rest of the world were to buy the yen, sell their currency to buy the yen and then buy a bond, short-term government bond in Japan, they were making a positive 3% real return. Now, remember, the real rate is restrictive. The higher this goes, the more restrictive it is. And sure enough, they got their wish, and that by hiking rates, by raising rates, that absolutely popped the bubble. That created a banking crisis. Banks were heavily leveraged, and corporations were also heavily leveraged. Non-performing loans were estimated at like 1 trillion US dollars worth, which I think worked out to like 100 trillion yen. The degree of the crisis was so severe. Clearly, we saw what it did to the stock market. Well, it also did the same thing to the real estate market as well. Real estate value, property prices crashed as well. And the reason for this is that the leverage during a blow off top, when private banks are extending more and more credit, they're taking more and more risk, especially if you can't get a positive return. If you cannot get a positive return with, say, buying treasuries, government bonds, if you're getting 10 basis points real return over inflation, well, you have to take more risk, right? So that's kind of the goal with zero real rate or negative real rate, is to stimulate lending. Well, they got their wish, and whether it was the private banks lending way more money than they should, becoming way more over leveraged than they should. Of course, the central government had issues, and with yield curve control and all the things we covered, from the following the pop of the bubble. We covered that in the other video, but both sides suffered significantly, and unemployment shot up, and it really brought the bubble to a heel, and popped it in pretty short order. So we can see here from 1990, it was January 1990, up until here in September. So not even a full year, the stock market declined. The Nikkei declined by 47% in just about 9-10 months. Real estate values crashed as well. They didn't crash as fast or as much, but very, very significant real estate correction in real estate prices as well. Clearly, it lasted for a long time. This is the lost decades that we kind of went over in the other video. So I'll link that at the end. But yeah, when the other side to encouraging liberalization, encouraging risk taking, encouraging deregulation, and a ton of credit creation or money printing. Well, the other side to that is eventually an economy can get to the point where it's so over leveraged that even a tiny little hike in interest rates. I mean, we can see that the real rate when the bubble popped was no higher than it was back here in the early 80s. We had a real rate back here of over 3.5%. So the real rate itself was really not that much higher. It's just that so much leverage had been taken on down here at 0 and 0.5 and 1, right? As the central bank was cutting interest rates to try to weaken the yen, to bring back that current account surplus, as they were doing that, the amount of risk taking just piled up and piled up and piled up. That's what causes a blow off top in, say, a stock market or a real estate market. But then what that means is that there's a bunch of bad debts. And so the minute that they hiked rates, even just again to a historical norm, a historical average of, say, 3% real rate, that alone was enough to pop the bubble. And so this is a warning in what can happen. If you take the private credit creation and the kind of liberalization to such an extreme as Japan did, it can create an asset bubble, the likes of which really haven't been seen for a long, long time. You have to go really back to, say, going into the Great Depression, the Roaring '20s to see this sort of bubble in America. Now, some would say that the bubble that we are currently, some would say that the current conditions we are seeing are a bubble. and it must pop, much like Japan, I would point out two things. Number one, our debt to GDP is 125%. So we cannot allow for deflation. We cannot allow for collateral on the real value of the collateral to fall too much, or we go into a debt spiral. I would also point out that throughout the entire period of time, Japan ran a current account surplus. They ran a trade surplus. The US, on the other hand, runs a massive current account deficit. And likewise, Japan has positive net international investment position. Japan has accumulated savings because of this current account surplus. Their country as a whole and overall has savings. For example, they got over $1 trillion of US Treasury bonds. On the US side, we have negative savings. In fact, we just have more and more debt. So those are two critical differences that number one, the debt to GDP is too high to allow for a sharply deflationary spiral. It would cause an imminent debt doom loop here in America. But also, the net international investment position is so negative, 100% of GDP, negative 100% of GDP, compared to Japan, where it's a positive 80% of GDP. So they have savings, we have debt. And also, from a defense standpoint, they have a lot of their defense costs basically subsidized by America. So there are a lot of key differences. Of course, demographics are slightly different as well. There are more significant a greater number of differences that we won't go into here, but I think those are the main ones. The fact that they have ran a current account surplus, accumulated national savings. Meanwhile, the US has run a current account deficit, is a debtor nation, and has only accumulated debt, no negative savings, actually. That's a critical difference. Also, as well, debt to GDP being this high just cannot, in a highly levered, 20 to 30 to 1 levered system, you cannot allow for the collateral to fall in value. Otherwise, you go into a debt doom loop, into a debt spiral. So, in my opinion, you can't really draw parallels. They're two totally different sorts of situations. But anyways, I hope that it was at least somewhat instructive on kind of how the bubble got blown. It's very, in some ways, it is similar to America with kind of reckless central bank policy, monetary policy. But in a lot of ways, Japan is quite different from America. So, anyways, hopefully that was helpful. And I will catch you in the next one.